Hi, and welcome to Macro Wednesday, where we talk macro, try to make sense of markets that really don't make any sense, but more importantly, answer your questions so we can become better investors. I'm Steve Van Metre, I'm your host, and thanks for joining me today. Have I got a great show for you today, because I want to talk about what is macro? What do you do with macro? Why should it be important to you? Why does macro matter in your life? And how can you use it? But before we do that, I want to say you are awesome. And I saw the video views from that 90-minute video on the Q&A marathon. And I'll tell you what, an hour into that, I was running out of steam. You probably noticed that. I was running out of steam, and you delivered. You came through. You watched it. So what you're telling me is you want more Q&A videos. But based on the feedback, we need to shorten them down. So I have quite a few announcements that I want to share with you before we get started with today's show, because you've noticed some changes. Number one, the comments now on the YouTube videos are enabled. Feel free to comment. Do know I am probably not going to have a lot of time to look at them. I'm not going to have time to answer them, and I'm not going to pull questions from them. That's very important. If you have a question, you're still going to need to email me. You can go to my website, which I've been asked. Please put the link to your website in the description. I will do that. Please put your Facebook link, LinkedIn. You can message me on either of those two platforms. That will be how questions are submitted. It works that way for me. So we'll do that. If you do have comments, my wife will probably actually read them more than I do, so you can leave stuff there for her. I'm sure she'll share with me the more interesting ones along the way. So you can use that to discuss concepts, ideas, and maybe find questions worth sending in to me. And I think that's great. I also got some other tips, some from behind the scenes YouTube things to do. So thank you to my friend who helped me with that. I appreciate that advice. And so here's some of the things on how we're going to do questions going forward. I'm still going to do questions. We'll still do that. No change there. I did get a request to put the questions up on the screen. So from now on, all the questions will be copy and pasted into a PowerPoint. I'm not going to edit them. So if you send a bunch of typos, that's just the way it's going to be. Still, no names will be disclosed. Obviously, due to licensing and privacy issues, you will remain anonymous as before. So you don't have to worry about that, but you'll get to read the actual question. Now, when I get a backlog of, say, 10 to 15 questions, which I currently have right now, what I will do is then plan to that coming Friday, so 2 days from now, I will do a separate Q&A video and release it over the weekend. So I'm already planning on doing that. And so I'm probably not going to take any questions in today's show, maybe tomorrow, because I really just want to share with you today why I'm interested in macro, how it's made a difference in my life, and how you can use the same thing. So I thought this would be just a different pace, because we don't have a ton of stuff to look at that we can't just look at on Friday, since I'm going to do another Q&A special. And that should run around 30 minutes or so and give me about 3 minutes to answer a question, prepare some graphs, which I didn't have a lot of time to do in the 90-minute marathon. So that will be new. I also had a request that if I get backlogged on questions and I can't manage it, that we go to a voting system. So I'd like to use that as a last option, but if possible, we will do that. But we'll just see how it goes. And if I do a Q&A special every weekend, maybe that's just how it will be. We'll just get a feel for it. But I want to keep that up, because I think your questions, not only does it help you, but it makes me better. And I want to be better. I want you to be better. And I want us as a group to be better. And I think that's pretty powerful. So hopefully those changes are coming through. Now, you might notice something in the back there. My dad came in and painted the big stain there. We've still got some more, which we'll work on getting the landlord in here at some point down the road. My wife, as you notice, may have cut my hair again. Last night I got her some clippers. She said, don't turn to your left. I thought the clippers would be a fail-safe, but we're working on that. She did pretty good, but if you have barbering comments, leave them in the description for her. She'll. The good thing is it's hot this week, and my hair grows long, and I'm not going to have anyone my hair grows fast, and we won't have anyone in the office. So I appreciate all the effort that she did, my dad did, and that you did by supporting the show and watching that Q&A video, giving me a lot of great feedback, and we're going to make some changes for you. So I appreciate that. So what is macro? I think we need to start with, why does Steve love bonds? I think that is a question that probably is one of the most popular topics on the show is Steve loves treasuries. He's obsessed with them because, and I made a lot of notes. So what do treasury yields tell me about the economy? Why is it so critical to macro? Well, it tells me is the Fed's easing or tightening, is it working? Is it doing anything? Well, treasury yields tell me that. It tells me is liquidity entering the economy. It tells me is there inflation or deflation. It tells me is the economy expanding or contracting. Are financial conditions tightening or are they easing? Are stocks more likely, keyword more likely to rise than fall in the future? See, treasury yields tell me everything. And you can't have macro without treasury yields. So that's why I like them, why we talk about them so much, because so many people just say, whatever, the bond market doesn't matter. But look at the last 2 days in the bond market alone. We had record issuance of 2-year and 5-year notes. And everyone says, interest rates have to go up because the government's issuing so much debt. And they really didn't. They went up a little bit, but they really didn't. Not when you have back-to-back record issuance, and tomorrow we'll have the 7-year note issuance. And again, you'd think with all this debt issuance, interest rates should be like a bazillion %. And they're not, because the market doesn't work that way. When you understand macro, you realize how things actually work. So a lot of people are wondering, Steve, you seem pretty conservative. And you got to understand, when you manage other people's money, how you approach markets shift. When you're young and you want to, chase the upsides and short the downsides and take a flyer on a bankrupt company, that's all cool. But when you're managing other people's money, can you imagine at a click of a mouse moving 10 million, 20 million, 50 million, 100 million, 200 million at one click of the mouse? And it's not virtual money, it's real money that involves other people. So when you do that, what you look for in the investing world are layups. Basketball games aren't won consistently by 3-point mid-court buzzer beaters. They're built by layup after take the easy shot. And in the market, there's all kinds of easy shots. Sometimes you got to wait for them. Now, if you look at market bottoms, major stock indice bottoms, you can generate roughly a 50% return in about the 12 months following if you can just tag the bottom within a 2-month range. You go, well, that's not possible. Well, actually, it is. I developed an algorithmic strategy that actually seems to do that extremely well. But that beyond the point, if you could still find a market bottom within 2 months, over the next 12 months after, you're going to make a 50% return. So let's say you had $100,000 and you bought near the bottom, and you make 50% with not much downside risk. Now that's pretty cool. So why do I like bonds? Well, in a deflationary environment, going into recession, bonds actually help increase my return. So let's say that I was in long-term bonds, took that $100,000, put it in long-term bonds. And let's just pretend, and this is not based on anything going on right now, but let's just say I made a 20% return going into the market bottom. And then I turn around, again, within 2 months of the bottom, following the same thing, I reinvest that and I make a 50% return. How much money do I have? Well, I have $180,000 now because I went from 20% return to 120 and doubled that. That's 60,000, or not double, 50%. So it's 180. So I can make 180. I can make an 80% return with not a lot of risk. Where are you going to get that in the equity market at near a top without taking a lot of risk? See, that's what macro is. And you say, well, that's not possible. Well, it is possible. Here's 10-year treasury yields. Let's zoom out. And let's overlay the S&P 500. And we can go back to 2008. Here it is. We'll zoom in. And look, yields bottom. Wait a couple months, buy stocks. Wait a couple more months to wait that 2 months after. And there, boom, over the next year, there's your 50% return. So what macro does is it helps me find low risk, high reward opportunities. Now, as a money manager, that could be really important. See, a lot of this is perspective. Now, for all you know, I might manage a lot of young people's assets. Maybe I manage a lot of people who are older near retirement, in retirement, or in their late stages of retirement. And that makes a big difference on what you do. Because if I take a young person who has $5,000 and I lose half of it being, taking some risk, and I turn in $2,500 and I tell them, well, hey, you know what? You're young, take some risk. You're 25 years old. What's the big deal? $2,500 in your life you'll find other ways to make mistakes where you lose more than $2,500. I promise you've got time to get it back. Now, let's say I take someone who's, say, 68, 70 years old, who has $500,000, and I turn it into $250,000. Now, what did I do? I may have kept them from retiring. I may have ruined their retirement. I may have done a lot of things. And if you're their kid, you're going to be super unhappy. So the key is, how do I find, as a money manager, using macro, these little layup shots that can still potentially generate pretty big returns? Well, that's part of the reason I like macro, and part of the reason why I like the bond market, because it is that great guide to tell me what's going on. So right now, it's not like I just got to be patient and let things play out, because I know how this ends. I know how the bond market ends. I don't know how the stock market, I don't know where it's going to go in the meantime. I know eventually where it's going. I just don't know exactly when. So why am I so conservative? Well, one, I do have an older client base. Number two, I'm pretty fortunate. I hit my retirement savings goal 20 years early. And on top of that, I'm debt free. So can you imagine that? You do your own retirement plan and find out 20 years ahead of the game, you got where you needed to go. And all you have to do for all yourself and your clients who are older is find an easy way to make that big return, that maybe 50% return off the bottom, which is going to happen, because that takes care of them too. See, that's what's cool about this. And there's other opportunities. See, at market bottoms, it may not just be the major equity indices. And maybe there's energy stocks. Maybe there's inflation-sensitive sectors that you like. There can be all kinds of doors that open, and they all have great opportunities. So for me, imagine this. Imagine this. You go to work every day, and you get to work with just the people you want to work with. How cool would that be? And if for some reason someone comes into work and they decide they don't like you anymore, and it's okay that they leave. They go find a job somewhere else, and it's okay. Or maybe you're talking to someone new who's going to come work for your company or work with you, and you decide that maybe they're not the right fit, so you recommend your competition. Kind of that's where I'm at. And it's a pretty cool place to be, to get to work with people who you can call your friends. That's what macro does. It changes the game. Because playing chase can hurt. Now, I have top timed some markets. I'm not going to go through some of the dumb things I've done that have come out with my skin on my head. I could also tell you all the stupid things that I've done and lost money. It's not worth trying to chase high markets, because wealth is created at the bottom. When you buy low, you have a chance of loss, but it's minimal. And so when you look at macro and you look at what it can do in your life, it can change things. See, I bet everyone that's watching this has played that board game Life. Probably everybody on here. If you haven't, go try to find it. It's a fun little game. But you know what macro is? It's winning the game of life. It changes things for people. Macro changed my family because of things that my father did. He changed the outcome of our family. Because of things I'm doing, I'm changing the outcome of my family. And by doing these same ideas, by studying macro, look, it's not going to tell you should you have bought the market in March. Macro's not going to do that, but it's going to change some things on how you do them. It's going to help you know where to be and what's going on. So again, it's not timing the market. Macro isn't going to do that. Now, it's going to do it on a large scale. Like I said, it's not going to tell you, hey, you could buy stocks in March and maybe we're okay. No, but it's going to tell you, hey, there's a major bottom here and it's time to go. And if you don't believe me, you saw it right here in this chart of back in 2008. Yields said, hey, there's a bottom and rates are going up. And stocks said, hey, sounds good. We're with you. See, that's what macro does. It creates low risk, high return opportunities. It won't tell you what dips to buy. It will tell you if you're buying high or low. So right now we know the market is high. Because of that relationship between treasury yields and stocks, we know for a fact that markets, stock prices are disconnected between yields. Yields are telling stocks, hey, I don't know where you're going, but you're going to be back down here. And stocks are like, no, inflation's coming. You better come join us. Look, treasury yields are more right than wrong. So if people are playing this game, and that's fine, how you manage your money, what you do is cool. I mean, it's awesome. Do whatever you want to do. It just tells you what kind of risk you're taking. That's what macro can do. And if done right, like I said, if you do macro right, it will open up doors of layups. You know, I've said before, when yields bottom, you'll find opportunities in inflation-sensitive assets, major stock indices, other things. You'll find them. They might not happen all, the same day, but if you miss one, another door will open. If you miss that, you probably get a third door. You don't get that in other places. You get that with macro. I was talking to one of my clients today in Texas, and we were talking about what macro does. See, macro is like meditation for your portfolio. Because so many people have what I call IDD, investment deficit disorder. They're like, oh, I got to go over here. Oh, no, I got to go buy that. Oh, no, look, bulls are over here. Oh, no, wait, no, it's bearish. I got to jump. I got to switch. Look, it drives you crazy. You turn on the TV. Oh, no, they're recommending I do this sector. And then you turn on the radio. Oh, no, I got to go over there. And then you go to some blog and you got to go buy this. It's investment deficit disorder. What macro is, and my friend will love this, it's investing in the now. Macro is investing in the now because when you know where things are going, you can make your investment and then move on to some other things in your life and know how it's going to play out. Say, like I said, I know how the bond market is going to play out. I know what's going to happen because I know what the Fed's going to do. I know how investors are going to handle this. I know the money multiplier is the most critical data point in determining inflation or deflation. I know that. So I know how it's going to play. I just got to put my chips on the table, let the wheel spin, maybe go have a drink and watch a show and come back later. That's macro. It helps you look forward. When you make major decisions in life, macro can have a huge change. It can have a huge change on your future. If you buy, let's say you take two people, right? Two people who, say graduated college together, get a same job, same salary, and 30 years later, you can have completely different financial outcomes. Because one person bought their house at the bottom of the market while the other person buys it near the top. Macro can tell you that. It doesn't tell you what day, what month, but it says, look, this is a better time to buy because you have less downside risk. Now, for example, I bought my house. That's nothing fancy, but I bought it in late 2009. Now, oddly enough, it really hasn't appreciated a tremendous amount, but when deflation hits housing prices, what am I expecting? I'm not expecting it to deflate that much. Now, if I went out and buy a house today, guess what I would expect? The price to deflate a lot. So if I'm going to buy a house or I'm in the market to, I want to wait until the recession hits. I want to stack up my cash. I want to make sure I keep my job and buy low. I want to do the same for stocks. I want to do that with cars. I know every day is a sale day. If you ask my boy, you want to buy a car, today's the best day. Yesterday was pretty good, but today is better. Tomorrow will still be good, but right now, today is the best time in your life. The best time is when they can't sell them, period. And they're desperate. When are they desperate? When they have the biggest inventory they've had. In recessions, when they have no buyers. Macro can help you with your employment situation. Let's say your late cycle, your boss gives out raises because business is good, right? Typically happens in late economic cycles. Rather than run out and spend that because you know where the economy is headed, you use that bonus or the raise to start paying down your debt. So when things start getting bad, you walk in your boss's office and say, look, I know you're going to have to make some decisions and get rid of some people and cut. I'm willing to give you back my raise that you gave me a year ago if you'll keep me. Boss might go, wow, why is that? Because I want to work for you. I want to keep my job. But if you spend everything you make, you can't do that. But sometimes macro can help you know when to do what. So you want to pay off debt, late cycle, acquire assets, early cycle. That is what macro is. It's also about how to filter the news. You know, this is really what's helpful for me. Because we look at the news and we know things aren't real. We know the Fed cannot print money. If the Fed could print money, you would have received a check from the Fed, or somebody you know would have at some point in their life. The Fed cannot print money. You can read the Federal Reserve Act. It says they can't print money. Now, I know the Fed comes out and says, we could print money. No, they can't. Show me the money. Show me what you printed. Didn't print anything. Didn't think so. But see, it helps you. Because when you hear that noise, right, as an investor, you need to close it off. You have to have your thesis on what your macro view is, where the economy is going, how are you positioned, how are you going to make money? And then you need to close off the noise. And macro helps you do that. Let's talk about, say, the coronavirus and its effect from an investment standpoint. Why has the market been going up? Oh, there's going to be a vaccination. 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 Look, here's the facts about that. Do you know how long it takes to actually create a vaccination for something? 12 to 18 months. To go through all the trials and all the tests and all the things to make sure. So let's just pretend there was a vaccination today. It's still going to take 12 months to go through all the trials to make sure that this thing is what they think it is. So that's a year. Now what happens next? Well, guess what? We have to make a bunch of these vaccinations. And we don't have the capacity in the United States or the world to make enough of vaccinations, because how often do we all go get vaccinated? Not that often. So guess what? We do not have the manufacturing capability to manufacture enough vaccinations for everybody. At least not quickly. It'll take years. So now we have to spool up that. And what if we need more than one vaccination? Sometimes you need 2, 3. Well, we need even more capacity. I bet you didn't know that we don't even have enough needles to do all the vaccinations that we might need to do. So this could take years. So you can have a year to get the thing, and then you might have another year or 2 to go around and get everyone vaccinated once, twice, 3 times, whatever it takes, assuming that there's actually a cure for a coronavirus, which we've never had one for. I think someone said, yeah, there was a cure, but it's a coronavirus cure for camels. Okay, so there's no human cure for these things. But yet investors are like, oh, look, the vaccine, boom, bye. Look, it's noise. Because in reality, if we just do social distancing, testing, and contact tracing, we could probably get rid of this thing within less than 3 years. And that's probably what's going to happen. See, that's how I cut the noise out. How about this whole inflation thing? Oh, look at all this treasury issuance is coming out. It's going to be, I hate the news. It's going to be really inflationary and drive yields up. That's funny, because it hasn't driven yields up for 40 years. Is it because we just hit $25 trillion in debt that suddenly now debt issuance is inflationary? Or is it because we're doing more than we did last year and maybe now it's inflationary? Look, it's noise. Macro turns all that noise off. Everyone's so bullish that the economy's coming back. What does macro say about that? It tells you it's not going to be this big V-shaped recovery. Everyone's saying the economy is going to be like this, a V. It's going to go from bearish, wait, let's see if I can get this right, bearish to bullish. There, it's going to do something like that. No. Look. Let's pretend everybody gets their job back. We'll just say everybody goes back to work, even though I know there's layoff announcements today. Let's just pretend. And I know some people watching this show have lost their job and it's not coming back. I know, but let's just pretend everybody gets their job back. And everybody agrees to take a 10% pay cut. Well, we'll just say 10% because the state of California is talking about cutting all state employees by 10%. And if they do that, I guess what's going to happen? County employees are going to get cut, city employees are going to cut, school districts are going to get cut. Everybody's going to take a pay cut. So let's just pretend everybody goes back to work to their same old job and takes a 10% pay cut. Now, where does that 10% come out of? Is it going to come out of their mortgage payment? Nope. Car payment? Nope. Credit card payment? Nope. Grocery bill? Nope. discretionary spending. That's enough to cause a recession. What if just 5 million people don't get their jobs back? That's a recession. See, all this notion that there's going to be a V-shaped recovery, it's noise. And what it does is you see the smart money is trying to go to people and encourage people to buy stocks. That's why you'll see some days like today, the market's up. And then what will happen, they'll be selling in the next day or two after all these people chase it higher thinking, oh, there's some cure, there's some inflation, there's some this, there's something that. Macro tells you, stop listening to the noise. Invest in the now. That's what it teaches you. It teaches you how to have a clear focus. And it can change your life. Imagine if you could start buying, what if you could buy your home near a market bottom, or buy a car when it's even cheaper, or save up in your 401k and not lose it when the market went down to buy more stocks at the bottom, because maybe you bought bonds knowing there's deflation coming, and instead of having what you had another 5, 10, 20% more money to buy risk assets. Those little things in the future of your life can make a difference. See, one thing changed my family's life. One thing that my dad did that somebody like me gave him advice or changed our whole outcome of our family. And he's listening right now, and he knows, he's talked about it plenty of times. Changed the whole outcome of our family. And from there, he went on to make even better decisions because he got smarter and learned something, and learned that, hey, you can do other things to have better outcomes. And you can too. That's what macro is, my friends. It's winning life. It's having a better outcome than your peers. It's having less stress about your investments. It's having less worry when recessions hit because you save. Macro is a saver's best friend. I can tell you I've made way more money buying stuff cheap than I've ever made trying to chase tops of whatever it is, whether it's cars or real estate, stocks. I've made more money consistently buying things that were cheap. And I can do that with macro. That's why I love macro. That's why I study. That's why I look at the data, because it tells me so many things. And when you start to understand it, it can start speaking to you. And it tells you, hey, Steve, you can get that low risk layup return, and then I'll give you another layup return. After that, I'll give you another one. And you'll find out that you can make more money faster with macro than you can elsewhere. Now, does that mean you shouldn't have a trading account? No, it doesn't mean that. Go have fun. It just means take the part you don't want to take risk with and use the macro philosophy. Invest like that, and you'll find out it's really peaceful, because you can actually go to bed at night. And sure, you can wake up and look at the futures. Who cares? If that's what you like to do, look at them. But it gives you a nice long-term focus. It clears the noise. It helps alleviate investment deficit order and helps you invest in the now. So we'll be back on Friday. We're going to talk about the credit data. We'll go over how hedge funds are positioned. We'll kind of wrap all that together. And then what I'll plan on doing is having another Q&A. Hopefully it'll be a lot shorter than 90 minutes for you this weekend. I've got some great questions, and I want to be able to spend a little more time going over them. And that will also help me stay more topical rather than, 2 weeks ago, this question came in. It kind of loses its luster a little bit. And I think we're on a great path, and I want to thank you for being here with me. And hopefully today's video, you have a better understanding why macro is so important to learn, not just from investment, just for your life, because you too, you can be, as President Trump says, a winner. I'm Steve Van Metre. Thanks for watching. I'll see you on Friday. Bye now. The content of this video is provided as education information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation of buyer or selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.